Well, I think, as we say in the report that we published this morning, although the region remains extremely volatile, there's another incident this morning, and although the attacks on Saudi Arabia were extremely serious, once the initial disruption has been contained and business is as usual, as we say in our report this morning, the market looks at the fundamentals, and short of a catastrophic geopolitical incident, the oil market remains fundamentally very well supplied. There's plenty of supply coming on stream. We have very high levels of stocks. So in terms of the actual fundamentals of the market, disruptions to supply so far have been relatively limited.
Just looking at your report, I see that you still see stock draws in the fourth quarter, despite that quick recovery from Aramco. Presumably, those are stock draws from Saudi Arabia, from OPEC as a whole, obviously not from non-OPEC.
Well, no, the stocks, it's an implied stock draw because we actually see in the latter part of 2019 a surplus of demand over supply for a short period. But as we said last month in the September report, it's a temporary respite because the big increase in supply we're seeing from Brazil and Norway, and of course ongoing increases from the United States, means that in the early part of 2020 we get back to a market which is very well supplied, and has been very well supplied for the whole of 2018, the whole of 2019, apart from this current period. And we get back to the fact that the oil price is likely, short of a major geopolitical incident, to remain under pressure for some time to come.
Now, Neil, let's talk about the demand side here. Today in this report, you've cut your 2019 and 2020 oil demand growth forecasts. Give us a little bit of color around what's driven this reduction. I know part of it is technical, but how much of this is driven by the trade war that's ongoing?
Well, a large part of the 2019 reduction, as we explained in the report, is technical. But yes, of course, to some extent, it also reflects the fact that trade tensions are visibly impacting on global trade. And of course, the broader economic mood music is not as nice as it has been previously. So we've made a very modest reduction in our 2019 growth number. Looking into 2020, we looked at the latest OECD GDP outlook that was published a couple of weeks ago, and it does look as if they're expecting weaker growth in 2020. So reflecting that and reflecting ongoing tensions over trade, we've again made a small reduction in our growth outlook for 2020. But that growth still remains 1.2 million barrels a day. So that, for the moment, remains fairly robust. But of course, we'll have to see how the economic news plays out and whether or not there's any progress on the trade talks.
What kind of upside are we talking about here? If we do see significant progress on the trade talks, are we going to see oil markets bounce really significantly if we see some concrete steps forward here?
Well, we can't speculate on how much oil prices might move up or down depending on specific events. All we have to watch is news from the trade talks. Will the mood music be more positive? Will other economic concerns, such as any impact there might be from Brexit, if that happens, and wider concerns about the struggling economies or the weaker economic news in, for example, Germany. There's an awful lot of factors to take into account here. And for the time being, it's difficult to know what the picture will look like. For the time being, we stick with a growth number of about 1.2 million barrels a day for oil demand next year. And of course, we'll review that as real data comes in and as the picture gets clearer. But something we should bear in mind here about oil prices is that today's prices, even with the small bounce we've seen this morning after the latest incident, they're trading at roughly 25 to 30% below the levels we saw last year. And that is a major benefit to consumers around the world, and we shouldn't underestimate the impact of that.
Hi, I'm Joanna Bersecci, and thank you for watching. You can check out more of our videos by clicking on the boxes on the screen. And don't forget to subscribe to our channel for more from CNBC International. Thank you for watching.